All right, let's break down Coinbase's latest earnings. There's a lot to unpack here for investors, so we're going to get right into it. So, Coinbase just dropped a massive quarter that blew past expectations. But you and I know that for a serious investor, the only question that matters is this: is the stock a buy right now? To figure that out, let's just cut through the noise. I'm going to show you the three numbers that tell most of the story. First up, revenue. They pulled in $1.9 billion. And look, this wasn't just a little beat, it was a huge beat. That tells you the momentum here is real. Number two, that's a 25% jump. Not year over year, quarter over quarter. That kind of growth, quarter after quarter, is exactly what you want to see. It shows things are really accelerating. And the third big one, $801 million in Adjusted EBITDA. That's the profitability number Wall Street obsesses over. So, huge revenue, massive growth, and big profits. Those are the headlines. Now, let's dig in and figure out what's actually going on under the hood. Okay, section 1. To really get a handle on Coinbase, you've got to know that all that revenue comes from two very different places. Two engines, if you will. And here's that split. Now, what's so interesting here is the balance, right? You've got 58% from transaction revenue. The classic trading fees that can be super volatile. But look at this. A full 42% is now coming from subscriptions and services. That's the steadier, more predictable side of the business. And for long-term investors, this mix is absolutely critical. So let's look at that transaction side first. The growth was just explosive. Consumer trading volume shot up 37% in a single quarter. Now, to put that in perspective, the entire US crypto market only grew 29%. What does that tell you? It tells you Coinbase is stealing market share, plain and simple. And this right here is maybe one of the most important charts. Look at where that trading revenue is coming from. Bitcoin and Ethereum? Yeah, they're important, but together they're less than half the pie. The biggest piece, 38%, is other crypto assets. This is huge. It means Coinbase isn't just a Bitcoin and Ether exchange anymore. They're becoming the default platform for the entire crypto world. Okay, let's switch gears to that second engine, subscriptions and services. The key number to understand this whole side of the business is this one, $516 billion. That's the total amount of assets people are holding on the platform. And that giant pool of money is what generates all that stable revenue from things like stablecoins, staking rewards, custody fees, you name it. It's a fantastic recurring revenue machine. All right, section 2. So the quarter was great, we get it. But as investors, we're paid to look forward, not backward. So what's the plan? What's the blueprint for future growth? Well, management has been pretty clear about their vision. This quote from the shareholder letter really nails it. They have two big goals: become the everything exchange for trading and scale up payments using their stablecoin, USDC. And they're breaking that vision down into 3 concrete steps. First, just keep adding more assets to trade. Simple. They already cover about 90% of the market cap. Second, go hard after derivatives. They've launched perpetual futures in the US, which is a massive market. And third, keep pushing USDC for payments. Its market cap just hit an all-time high, so that's clearly working. Okay, section 3. Now, any good analysis has to look at the other side of the coin. It can't all be good news, so let's talk about the risks, the rising costs, and the red flags you can find right in their SEC filings. And this table is a big one. You see, revenue isn't the only thing growing fast. So are their costs. Look at this. Double-digit jumps in expenses across the board in just one quarter. A lot of that is from hiring more people and buying other companies, like Deribit. So yes, they're growing, but it's costing them a lot of money to do it. And we need to talk about that profitability metric they use, Adjusted EBITDA. It's really important to remember this isn't standard accounting. It's a non-GAAP number. It's designed to show you the core business profitability, but it does that by excluding some very real expenses. The biggest one? Stock-based compensation. We're talking $222 million this quarter that doesn't get counted in that headline EBITDA number. You have to keep that in mind. And you don't have to take my word for it. If you actually read their official 10Q filing, the company tells you what the biggest risks are. First and foremost, the regulatory environment. It's a huge question mark. Then there's competition, which is fierce. They also point out their own stock structure, which gives the CEO most of the voting control. And finally, the obvious one. The entire business is tied to the crazy volatility of the crypto markets. So, Section 4. We've seen the incredible growth, but we've also seen the rising costs and the big risks. So where does that leave us? What's the bottom line for an investor looking at the next quarter? Well, here's what the company itself is telling us to expect for Q4. They're guiding for that solid subscription revenue to stay strong, which is great. But look at the expenses. They're telling us flat out that their operating expenses are going to jump again. This confirms their strategy. They're spending, and spending heavily, to capture future growth. And that brings us right back to the core question for every single investor looking at this stock. The growth story is powerful. The market share gains are real. The vision is clear. But you have to weigh that against the heavy spending and the dark cloud of regulatory risk. So is the current stock price justified? Does the long-term vision make up for the short-term risks and costs? That's the billion-dollar question you have to answer for yourself.